Very good afternoon, students. Now we will starting with another important topic of the financial derivatives. Yesterday we have covered in the last lecture we have covered till the that is your forward market. Now we have to start with the futures today. So there are many type of it. These all terms are interrelated to each other. That is your forward contract, your future contract. These all come under the term derivatives. Fine. That is derivative means when the value of the underlying asset is derived from the when the value of the instrument is derived from the underlying asset. So this is known as the financial derivative. So under the financial derivative, we have covered the introduction part, we have covered the forwards, and now from today we will start with the futures. So this is also known as the financial futures. Financial futures, your stock market futures, all these futures. Now, what is the meaning of future? Now, generally, if we are discussing the meaning of future contract, means when we enter into the contract to fulfill the obligations on some future date. So we will start with this. First of all, I will explain the meaning. What is the meaning of future? Now here. Now financial future contract. Now just if we are discussing about the terminology future contract. So as we have discussed in the business laws, it is the terminology of business law regarding the future contract. Now future contracts are the contracts in which we have entered today into the contract to fulfill the obligations and so on some future date. For example, you have sold 100 tons of wheat to the person of which the delivery is to be made after 3 months. So this is the future contract. The contract which has been done, which has been done between the two parties to sell the specified quantity of the asset specified after a specified period of time at specified place. So this is known as the future contract. So future contract again in simple language it means the obligation to be fulfilled on some future dates. Now obligation will include your consideration, all the things. So generally discussing the financial future. Now financial future means the future contract of the financial instrument. So financial, it may be of financial instruments, it may be of your any underlying asset. So it may be of your stock index futures. So first of all we will start with the financial future contract. So financial future contract is the agreement between two parties. As we know that contract is just the agreement between the two parties in such a way, in same sense, the financial future contract is also an agreement between the two parties to buy or sell specified quantity of assets. Now here, to buy or sell specified quantity of assets. For example, 100 tons of wheat, 200 tons of rice, 50 tons of pulses, 100 tons of iron ore, 20 tons of copper. So this is the specified quantity of the assets at a specified price. For example, iron ore at the rate of rupees 5400 per ton. So this is the specified price and specified time and place. Now after 3 months, for example, you entered into the future contract, that is financial future contract to sell 20 that is to sell 20 tons of iron ore at the rate of 5400 per ton or 540 rupees per ton uh, after 3 months at Jaipur. So here, what we have done now, this includes all the essential which are required for the financial futures. First, there is the asset. So the underlying asset is iron ore. The quantity, that is 20 tons. The price, that is 540 per ton. The place, that is Jaipur, and the time, that is after 3 months. So this is the example of a future contract. So this is known as a future contract, which has to be fulfilled on some future date. Now, next, traded on the exchange, which sets certain standardized norm for the trading in the future contract. Now, here, this contract is traded on the stock exchange or on the commodity exchange. Generally, we can say that these are traded on the commodity stock exchange. For example, in India, that is NCX, National Commodity Exchange, MCX, that is NCDX, that is National Commodity and Derivatives Exchange, MCX, that is Multi Commodity Exchange. So all these are the exchanges which are used to trade the financial as well as the non-financial future contracts. So these are the specified segments of the exchange in which the forwards and futures of the futures of future contracts are that are traded in the stock exchange. Now next, Moving to the now the types of the financial future contracts. Now the financial future contracts can be segregated into two major categories. First is your financial future itself, and second is your commodity futures. So we will start with the financial future today, and then we will explain the commodity futures also. So as it is clear from the name, the financial means the financial instrument or the term which can be converted into money, and future means a type of contract which has to be fulfilled on some future date. In second, same, it has a commodity future. So commodity future means the future contract to deal with the commodities like iron ore, wheat, uh, pulses, copper, gold, aluminum, all the things which comes under the category of commodities. So now financial futures are not different from the commodity futures because it is just like that. It is just a same as that, except the underlying asset. For example, in the commodity futures, as I have discussed, the commodities like food grains, metals, vegetable, etc. are there. Whereas in case of the financial futures, a particular financial instrument like equity shares, debentures, bonds, treasury bonds, securities, currencies, etc. traded. So this is the main difference between the financial future and the commodity future. In the financial future, the future contracts regarding the financial instruments like equity share, debentures, bonds, treasury bills, currencies, etc. are done. Whereas in case of commodity futures, the future contract regarding or the futures regarding particular commodity are traded over the exchange. So now the next is the type of financial future contract. Now there, the financial future contracts can further be segregated or segmented into various contracts. So first, it is the just starting with the beginning, that in first is the interest rate futures. Now interest rate futures means if we are dealing with the future contract of the interest rate. For example, a 10% treasury bill, fine, it means that the this particular instrument will bear a 10% interest on the maturity. For example, debentures, 20% debentures. So it means that if you have bought a future of 20, if you have traded a 20% future of the debentures, it means that this particular future commodity, that is the underlying asset, that is debenture, will bear the 20% rate of interest, or this will generate the 20% rate of interest. So this is the examples that we can explain. So here, this is the one of the most important financial future in the world. It has been started in the year 1975. So under the interest rate futures, the underlying assets which bears the return or in the terms of future return in the term of interest. Under the interest rate future, all the instruments on which a fixed rate of interest or a floating rate of interest is payable on the due date or within the year or within the specified time, and on the number of instruments. So this is the known as the interest. This all comes under the interest rate futures. So the examples of interest rate futures are various interest bearing securities. For example, treasury bills, the bills of the treasury bills which are generally issued by the government. Next is your notes. Again, this means the financial notes. It does not mean the currency note, it means the financial note or the promissory notes. Next, bonds. As we know that the bonds, again, these are the issued by the various government and government instruments. Next is debentures. Debentures of the generally the debentures of the government companies are also known as the bonds, are also known as the government bonds. Whereas uh, debentures debentures means, as we have discussed uh, in the socio finance, in the financial management in the second semester, that what is the meaning of debenture. So debenture is a instrument, financial instrument, which has been issued by the company by creating a fixed or floating charge over the assets of the value. So this is known as the debenture. So debenture is a debt instrument. It means that company has to pay a fixed rate of interest on the debenture. So that all the private companies which are issuing such debt instrument are known as that instrument is known as the debenture. Now next is euro dollar deposit. Now it means euro dollar deposit is another type of deposits, just like a fixed deposit which bears the interest rate. Next is the municipal bond. Municipal bond is just like a, we can say, we can take a example of national savings certificates, uh, bonds of REC, that is rural electrification bond. So all the bonds which are issued for some such purpose, and these are having the maturity values. For example, the NSE certificates are generally issued for the 7 years. Now in that, the money cannot be withdrawn before the maturity of the particular instrument. Now, although these are also non-transferable in nature. all the other instruments which can be, for example, bond, debentures, can be traded if they are allowed. But in the case of municipal bonds, these are non-transferable. Next, the market is further categorized into short-term and long-term interest-bearing instrument. Now, again, as we know that the stock market, there are two type of interest-bearing instrument. First is the short-term interest-bearing instrument, and another may be the long-term interest-bearing instrument. Now, short-term, generally we are discussing about the short-term interest-bearing instrument. These are the instruments which are generally for the period of 1 year or less than 1 year. Whereas when we are discussing about the long-term interest-bearing instrument, for the example of long-term interest-bearing instruments are your debentures, your municipal bonds, your NSE certificates, and the bonds of the government company. All these are the examples of the long-term instruments, long-term interest-bearing instrument. A few important interest rate features traded upon various exchanges are national grid contracts. For example, this is an example of national grid contract, as I have given example of REC, that is Rural Electrification Board. Again, in India, it is REC, it may be national grid contracts, or all these are there. Next, it is national grid, it is not national, it is national grid contracts, or and a short-term deposit future. Now, what are the short-term deposit future? First is treasury bill futures, that is T-bills, euro dollar futures, treasury bond futures, and treasury note futures. So these are the type of future contracts which are generally for the short-term deposit purpose. And for the long-term purpose, there are various other, for example, notes, your debentures, your bonds, your municipal bond. So all these are for the long-term. Now next, first we have discussed the interest rate futures. Now the next type of financial futures are your foreign currency futures. Now, as it is clear from the name, the foreign currency future means the future contracts of which are generally related to the foreign currency and the foreign transactions. For example, uh, we have bought a 3 month future of USD at the rate of 62 rupees per dollar. So it means that we have to buy, if we have entered into the contract, we have to buy that amount of dollars at the rate of specified period of time. For example, if I have taken the example of rupees 62 per dollar, so after 3 months I have to buy on the maturity at the rate of rupees 62 per dollar the number of dollars which I have to buy. But on the another hand, if the price of dollar, again we can say that if the price of dollar falls, then the person who is selling me is in benefit, and if the is in loss if the price of dollar falls. If the price of dollar increases or in relation to the Indian currency, then that person is in benefit because he has to pay less rupees to buy the dollar, and it will provide to me as it has been sold or it has been already entered into a contract to sell the future on the particular date. So in that date I have to buy the dollars on that same date, as we have discussed in the forward market arbitraging. As we have discussed that how the arbitrage functions are held in the uh, future market. So here again, the next is the foreign currency future. So these are the these financial, as the name indicates, trade in the foreign currencies. First thing, as I have already discussed. Next, thus also known as the as exchange rate futures, because these are traded on the some of the exchanges, that is on the commodity exchange. And important currency in which future contracts are made in, such as US dollars, as we have discussed, sterling pounds, yen, French francs, and Canadian dollars. These are the examples. In another companies also the futures are there, but these are the major currencies in which the dealing is done. Now let's take an example of US dollar. Now, if we have taken the example of US dollar, for example, I have entered in. Just take a text box and it will be more clear. Yes. For example, I have entered into the future contract to buy a $1 at the rate of 62, that is INR, at the rate of INR 62 after 3 months. So this is the one type of future I have entered into, that is the currency rate or foreign currency futures. So this is the thing after 3 months. So I have bought a 3 month future bought. I have bought a 3-month future to buy $1 at the rate of 62 per dollar. Fine. So if at the maturity, so this is an example of the foreign currency future. So now here the foreign currency future, the currency is a $1. So if I have to buy a $1 at the rate of 60 rupees 62 per dollar, fine, at the per dollar for $100. Now this is the one type of currency rate, that is the foreign currency future. Now here I will buy. I have put the command to buy the 100 USDs at the rate of 62 per dollar after 3 months. Now on the maturity, I have to buy this because I have entered into the contract. As we know that contract is a type of agreement which is agreement which is enforceable by the law. So here again, this is the agreement which is enforceable by the law. So if I have to buy this amount of dollars at the particular rate. Now, for example, if the price of the US dollar has increased in relation to the Indian national rupees, for example, on maturity, if $1 has become rupees 70, then I am in the benefit by entering into the contract. That is, the profit is, that is $8, that is rupees 8 per dollar. Now here I am having, if the price of dollar, it means that the price of Indian national rupee is falling and the price of dollar is increasing. So if the price of dollar is increasing in relation to the Indian national rupees, if the dollar is becoming more stronger, then there will be the profit of 8 per US dollar to me. Now taking another example, if the price of $1 on the maturity, if the price of $1 on the date of maturity becomes, let's take a 52 per dollar, that is 52 INR per dollar. Now what will be happening? I am having a loss of almost rupees 10 per dollar. So this is an example of a foreign currency rates. Now here I have entered into a 3-month future at the rate of 62 per dollar for 100 USD. If the price falls, if the price of the dollar increases, only if the dollar is becoming more stronger, then the currency value of rupee will deplete in relation to the dollar. So here, if the dollar has become stronger and we have to pay more amount to buy the less dollars, then for example, if the price raised to $1 is equals to 70, then there will be a profit of 7 in this contract. Else, the here the another party will having the loss. And here in the case the price of dollar has fallen, it means that Indian national rupee has become more stronger in relation to dollar. Then there will be the loss of rupees 10 per USD dollar to me. Here, this market mainly runs on the concept of one's gains and another's loss. For example, in this contract, if one party is gaining, then the gain of that party will be equal to the loss of another party. Fine. So this is the main concept of future market in the, or the in the stock market. So this is an example. Now it has been clear that how the currency. Now this is clear from this example how the foreign currency futures are valued and how these are traded. Although there are n number of restrictions or formalities to be fulfilled while entering into this contract, that is the foreign currency future contract. Although this we will explain when we will move forward to the next topics. So these are the examples in which the foreign currency futures are traded. Now moving to the next slide, the next important topic, that is stock index future. Now we have discussed the financial future. First is the interest rate future. Second, we have discussed the foreign currency futures, and now third is the stock index future. Now stock index means the stock indexes, the indexes which shows that what is the sensitivity or what is the uh, overall change in the value of the underlying securities. For example, if we are taking about the BSE, that is your Bombay Stock Exchange. If we take an example, let's start with that. In the stock indexes for the BSE is the Sensex. For BSE, now it consists of 30 companies. Now here, now if we are discussing about the stock index future, for example, if we are taking the BSE, so it is the average of the, that's the Bombay Stock Exchange. So it is the average of the 30 companies, that is the 30 top companies of the each segment, and the relative price change in the stocks of that particular companies are recorded, and these are indicated by the sensitivity index. In case of that, the full form is sensitivity index, and it is donated by the sensitivity index in the stock market. So here, if we are trading on the stock exchange itself, so these are known as the stock exchange features. For example, we have bought a Sensex at the rate of 45,000, a 3 month for future contract of Sensex at the rate of 35,000. Now, if the Sensex reach at 35,000, then the contract is fulfilled. Now there is a price that the future of 30,000 for 35,000 Sensex is rupees 30 per unit. So it has been derived in such a way. So the value, when in the case when the value of the underlying asset depends upon the stock market index. So here, these are the contracts based on the stock market index. Stock market index future contracts are mainly used for hedging and speculation purpose. Now the meaning of hedging is to hedge the loss, or to it, or the insurance against the loss, or the insurance against the risk. uh, we cannot say the insurance is the loss, it is the insurance against the risk, that is known as the hedging. And speculation, which hedging is done by the investors, and whereas the speculation is always done by the trader. So these are the two different things. So these commodities are traded by the mutual funds, pension funds, investment trust, insurance companies, speculators, arbitrageurs, and hedgers. These are the some of the persons who will do the trading on such stock index future. The examples of stock index future are Dow Jones Industrial Average, S&P 500, that is the Standard and Poor's, which will contain the 500 companies of the each segment. Next, total number of total 500 companies. Next is New York Stock Exchange Index, Singapore International Monetary Exchange, that is CIMEX, S&P CNX Nifty, that is the Indian. Fine. So that is Standard and Poor's CNX Nifty. That is common. Now these are the some of the examples of the stock exchange stock index future. Next is the bond index future. So now the moving to the next important type of futures is the bond index future. So these future contracts are based on the particular bonds. Now bonds means, again, it is a type of debt instrument which is generally issued by the government company. So particular bond, which indicate bond prices. As we know that prices of debt instruments are inversely related to the interest rate, because as these are inversely related to the interest rate, because if the rate of interest is more, the value will decline, and if the rate of interest is less, the value of the bond will be more. So that the bond index is also related inversely to them. So here it is also inversely to them, because at the higher rate no one is going to buy. For example, municipal index bond feature, US municipal bond, which is traded in Chicago Board of Trade. So this is an example of bond index future. Now next is the cost of living index future. Now cost of living index, it is another example of the economics. Now cost of living generally used to donate the inflation rate in the particular company. So if the futures are created, now here the index is the cost of living. So now the cost of living is donated by the CPI, WPI, and IMM. First is the CPI. So consumer price index and wholesale price index. So these are the two basic economic parameters which are helps in calculation of the which helps in the calculation of the inflation rate. So as we know that wholesale price index, it is the major index of the major indication of the inflation in the particular country. So here these are known as the inflation future, which are traded according to the rate of inflation in particular country. So these future contracts are based on the specified cost of living index. So there are two types of, first is consumer price and wholesale price index. These are the generally the topic of the economics, and we have already discussed. Next is IMM, that is International Money Market, that is generally in the Chicago. Next, operators or traders in the future market. Now, as we have discussed the operators and traders in the forward market, now we have to discuss the operators and traders in the future markets. Although there are most of the things which are common in the case of forward market and in the case of future market. So here we are discussing about the future market. So first is the hedgers. As we have discussed in the forward market, that hedger is the person who done the hedging against the risk. Hedging against the risk. Now risk of what? Risk of loss. So here hedge is the position taken in the future for the purpose of reducing exposure to one or more type of risk, as we are doing in the future market hedging. That is, if we are discussing about the interest rate hedging can be done in two of the way. One is the covered and another is uncovered. So mainly the interest rate, if we are doing if we are entering into the interest rate for future also, then again there may be covered or uncovered. Now if we are discussing about the covered, then it is covered by the currency rate fluctuation, that we are doing one contract in contrary to the another contract. For example, if we have entered into contract of interest rate future, we have done the investment. So to cover the loss of the currency futures, what we will do to hedge against the fluctuation in the foreign currency, we will enter into the future contract at the same time to sell the currency at the same rate. If we have investment, now we will buy the currency in the spot market and sell the currency in the future market. So now this is known as the hedging in the interest, in the case of interest rate futures. Second, now we will discuss what is the meaning of hedging. Next, a person who undertakes such position is called hedger. Now what is the type of position? That is buying in the spot market and selling in the future market. So this is known as the position. Next, hedger use future market to reduce risk caused by the movement of prices of securities, commodities, exchange rate, interest rate, indexes, etc. In the forward contract, we are only discussing about the interest rate, covered interest. But in this case, hedger can use the future market to reduce the risk which may be caused by the movement of prices of the securities, commodities, exchange rate, interest rate, etc. For example, if you have just we have taken the example of the interest rate, you have entered into the interest rate future because in two countries there are different interest rates. So there may be, as we know, the concept of in the forward market or in the future market, the rate of the difference between the rate of interest is covered by the movement in the value of the currency. For example, let's take an example. If the rate of interest in USA is less than the rate of interest in India, so what will happen till the maturity date? The price of US dollar will raise in such a manner that it will cover or it will compensate the price, the rate of interest, which is that is the difference is 4% in the two countries. So this is known as the hedging. So this is an example of hedging. A hedger will take a position in future market in the opposite risk which he has exposed. For example, you have bought some securities of the companies under the future market. For example, you have bought the 3-month future of Reliance Communication at the rate of rupees 100 per underlying per unit. Now, what you have done, you have bought this. Now, on the contrary, you will enter into the some other future contract to sell the number of securities in the market. So, in that case, the net effect will be nullified. If you are getting the loss in one market, then it is covered by the another future contract. So this is known as the hedger. Next, an opposite position to a perceived understand risk is called hedging strategy in future market. As I have told that for example, you have entered into the interest rate future. So what you will do, you will now here the risk is of the currency rate fluctuation. Now to cover that risk, what you have done, you have entered in, you have bought something in the spot market and sold something in the future market. So this is called as the hedging strategy in the future market. Now hedging strategy adoption in the future position that generates profit when the market value committed is higher than the expected value. So if the market value committed is higher than the expected value, then you are in the profit, else you are in the loss. Next, the example. A treasurer of a company knows that now this will be explained with the help of example, that how the hedging is done. How the hedging is done. A treasurer, a person who is having a control over the financial uh, data of the company, or he is having all the financial what he has done of a company, knows that foreign currency amount to be received at a certain future time may hedge. So be cautious, because the rate of currency never becomes stable. So the rate of currency is never stable. So the rate of currency always fluctuates. Now the person knows that the rate of currency will fluctuate. Now what he do? The foreign exchange risk by taking a short position. Now short position means selling the foreign currency at a particular rate. Now what you have done, you know that you will receive the, for example, you will receive rupees $100 after 2 months, and the treasurer of the company knows that if the value of $1 is 64 today, if the value of that dollar in relation to rupees, if the dollar becomes weak, so if the it now it becomes 50 per dollar, now there will be the loss in rupees to the particular company. So to cover that loss, what he will do, he will take a short position. Now short position means selling the particular foreign currency at a particular rate today. Although you don't have that currency, you sold that currency in the commodity exchange or on the derivative exchange. So let's take an example at the rate of 64 per dollar. Today you have sold. Fine. Now next we have entered into the contract, into the future market. Now we can take a long position, buying foreign currency at a particular rate in case future exchange dated payment at a specified future date. Now what he will do, he will buy that currency on some particular future date. For example, after 2 months he has to receive $200. Now today what he has done, he has just sold the 2 month future at the rate of rupees 64 per dollar. And now next, if the 2 month future to buy the dollar is at the rate of, for example, again it is available at the rate of 63.5. So he has bought that future. Now on the future date, the risk, now he has hedged the risk. Now how he has hedged the risk? Because now he has sold the dollars today at a specified rate, that is 64 per dollar. He has already sold. So when the payment is received by the company, it will be directly converted into rupees 64 per dollar on the particular date. Now next, if now next on the contrary, he has also entered into the long. Now enter into a long means that long contract means buying low and selling high. So what he has done, now he has to cover the risk. Now he may have entered into the price that is 62 per dollar. Now in the market, the rate is around 62.5 per dollar. Now what he will do, he will buy at the rate of 62.5 and sell and adjust the trade. Now on the date of trade off, what he will do, he will fulfill both the contract. One is by buying and selling at the higher rate. Now what will be happening, and delivering at the higher rate, that is buying at the lower rate and delivering at the higher rate. So the risk, that is the rate that is related to the currency rate fluctuations, are covered under this particular undercover this particular segment. So this is known as the hedging. So hedging is always done by the various companies, various traders. Anyone can do the hedging. Hedging means to cover against the, or to insurance against the risk. Now risk may be your currency fluctuations, risk may be your interest rate fluctuation, risk may be your inflation or the indexes fluctuation. So all the risks can be covered by entering into the future contracts, future contracts. So this is an example. Now next is speculator. Now speculator is the person, an investor who is willing to take risk by tasking future position and expectation to earn profit. Now speculator means it is a type of trader. Speculator, a person, is always a trader. So what is an, now we will take an example. Suppose the speculator forecasted the price of gold would be rupees 5,500 per 10 grams after 1 month. So here it is just an expectation. So the current price of gold is 5,400 per 10 grams. Now he takes a long position. Now long position means buying low and selling high. Buying a commodity at a lower price and selling the commodity at a higher price. So he has taken a long position of one in gold and expect to made a profit of rupees 100 per 10 grams. Now expected profit is associated with the risk. Now risk, what is the risk? If the price fall beyond this limit, then you have to sell the gold at 5500 because you have entered into the future contract. Now what happened? The expected prices as said gold is, so price after 1 month decreased to 5300 rupees per 10 grams. So he may lose rupees 100 per 10 grams because he has bought in the spot market at the rate of 5400. So he is getting the loss. And if he fulfill the contract in the future market at the rate of 5500 per dollar, then there may be the loss of rupees 200 per 10 gram. So this is how the speculation is done in the future market. So that's all with today's lecture. Next topic, that is regarding the type of speculator, arbitrager, all these things we will discuss in the next upcoming lecture. Thank you.